So next up, we have Nicole Agar from Truffle to present on the balanced fund. I believe this is Nicole's second time on the fund manager workshop. So we're really looking forward to it. Hi, Nicole. Can you hear me?
Hi, Julie, I can hear you. Thank you. Good to be here.
So good to have you. Without wasting any more time, I'd just like to hand over to you, and then I'll probably have a few questions for you afterwards.
Fantastic. Okay. Good morning, everyone, and thank you. Good to be with you again. As I'm sure you are all painfully aware, this quarter has been very much about talking about the increasing risks of recession, which have increased, as we know. And I thought I'd spend a bit of time talking about where we see those pressure points and what could play out going forward. First off, though, just turning to our returns for the quarter, and I think we need to see these against the backdrop of what has been a very difficult quarter for markets. So we know that the CAT Swix has been down about 11%, the Orbi was down about 4%, MSCI World was down a whopping 16% in dollars, but because our Rand weakened 10%, that was blunted to some degree by only a 6% negative return. And although, global bonds were down a good 8% in dollars, they actually had a net positive return in Rands because of our currency weakening. So against a slew of very negative numbers, our minus 0.8% for the quarter, we feel was very respectable, and I'll go through how we managed to keep those losses to a minimum. And the pleasing thing is, as markets being as volatile as they are, I actually looked at performance this morning, and year to date, we are back up to a sort of 1.6% return, at least positive, and hopefully some more to go. But you can see that on the 6 months, 1 year, 3 years, so short and long term performance history, we continue to have some very pleasing annualized returns for our clients. In terms of where we protected these, the performance from all these downside returns and risks this quarter, our biggest two factors would be, firstly, nice person process. We have been underweight that group for a very long time, but going into the end of May and beginning of June, we felt that the discount in Naspers was just unsustainably high, and we accumulated some 5% of Naspers in the fund. So we were well positioned for the announcement that came towards the end of June that Naspers and Process would be selling some of their 10-cent shares and using it for buybacks. And the share was thus up, 42% for the quarter. And this good positive return helped protect the performance in the fund and contributed more than 1.5% to performance. The other positioning that helped our returns was our hefty weighting in foreign cash. We were nervous about markets. We did have a sort of 10% weighting, and with what the Rand did, that also protected. And we had derivatives exposure, which we've now actually subsequently lifted quite a bit of, and that of course also gave a positive return as we were hedged against market declines. The thing that really hurt us this quarter would have been our banks. We know that in a risk-off environment, weak Rand and EM wary environment, banks do decline. And ABSA, which is one of our core holdings, was down 17% for the quarter. However, we now feel this share is even cheaper than it was. It is trading below book. It has dividend yield of close to 9%, PEs of between 6 and 7. It's well provisioned. They're doing a good turnaround on the retail side. And we actually have used this opportunity to buy some more ABSA. So turning then to our market outlook and what we're expecting. The first thing, as we are all acutely aware, is that geopolitical risks remain high. And it's not only the war in Ukraine, it is also what we are seeing happening in China with the increased military presence and the deglobalization as the world is fracturing from a sort of great going forward in the same direction. Recession risks are rising on the back of both an energy crisis, inflation, consumer confidence, property markets that are weakening. And yet we still don't think that earnings have been downgraded enough offshore. We think some have happened. The markets have definitely fallen, but we don't think that earnings have necessarily taken into account the extreme margin pressure we're going to see from all these rising costs on both wages and energy. We do feel inflation is close to a peak. But we do know that the Fed and other central banks are now very, very much focused on getting inflation under control. This talk of it being transient is over. Inflation has now become red hot. It's 9% in the UK, the US, and close in Europe. And we know that that is what the banks are focusing on. And of course, having been behind the curve, they are now very, very aware of having to establish credibility. So unfortunately, you've got this dual position of recession risks rising, and at the same time, big interest rate rises into these slowing markets. On the plus side, China has been so bad that it's almost good, and they are now pivoting to pro-growth policies, which we'll touch on a bit later as well. Now, turning to the war in Ukraine and what it has done, we do know that Russia supplies 10% of the world's gas, 18% of the world's coal, and a good 10% of the world's oil. And obviously sanctions on that have helped spike, contributed towards rising energy prices. But it is more than just that and sanctions, which is causing this huge energy crisis. It is also the fact that Russia has done what we call weaponizing energy. So I'm probably aware that Nord Stream 1, which distributes a lot of the gas through Europe and especially Germany, has been throttled for the last quarter and is only providing almost 40% of what it used to supply into Europe. The big D-Day on that is Thursday, as we wait to see whether the maintenance is over on Nord Stream 1 and that whether Europe will continue to get its gas supplies. But the situation is probably getting a bit worse because whilst China has been slowing, Europe have been able to import LNG, liquid nitrogen gas, to substitute for the fact that they don't have gas through the pipelines. And we think that as China starts to recover, this very ready gas substitute for Europe is going to be taken away. So we feel there is continued pricing upward pressure on gas in Europe, especially as it is fairly inelastic, and there will need to be huge increases to try and get demand on track. And in fact, we may actually see Europe having load shedding and countries such as Germany having to throttle their gas and gas supplies. Coal, as a result, which is another form of electricity and power, has also been on the increase. We've seen those prices rise about 100% as people have had to use coal as a substitute for gas. And in fact, bizarrely, we have now seen the Green Party in Germany saying that they're endorsing the use of coal for energy. So we continue to see increasing pricing support there. On the oil side, whilst Russia only supplies 10% of the world's oil, it's at a time when markets are very, very finely balanced in oil and coming into a market where the oil majors have underinvested, the refineries have underinvested, and the OPEC plus nations can't seem to actually increase and open up their pumps. So that at a time when supply demand is very finely balanced, you now have Russia, where we start to worry about will they continue to be able to produce their oil as technology and sanctions mean that those wells could be shut and they are very, very hard to open. We feel that Europe has a greater chance of recession than the US. They have been harder hit by the war in Ukraine because, of course, they are trade partners. It has a greater effect on their consumer confidence, and their energy inflation has been far worse. Gas prices up over 100% in Europe. They're only up about 50% in the US. Of course, there is a knock-on effect into the rest of the world in terms of what we see happening with consumer confidence, rising interest rates, energy inflation, food inflation. But we feel that the Europe and the UK are the ones that are at higher risk of recession. Of course, the US, its economy has its own set of problems to deal with. And we might see pressures coming from what we know to be unemployment is now going to start to rise. There are pressures on corporate margins. Mortgage rates are currently running at 5.5%. They also have rising inflation and consumer confidence has been hit. However, we feel that if the US does hit a recession, it will be a mild and shallower recession than we've seen in the past. The reason for this is that we think the consumer is still in quite a good space. They've still got a lot of excess savings from COVID. The wage markets are still fairly solid, even though we think, unemployment is about to tick up. And most importantly, there is a recession. This isn't a recession like the global financial crisis when we had a problem with our banks, and we had a problem with a property bubble and subprime. This would be a good old vanilla recession that's caused from inflation and markets heating up. However, at the same time that we're looking at the slowdown, we know that the US is really very much focused on inflation. We know that there was a shocking core inflation number last week of 9.1%. However, what we will say is that this shock was actually somewhat better than the May number, because in the May number, it came out at a time when oil prices were still going up and soft commodity prices were going up. And we've already seen those start to roll over. We're not saying that energy prices are going to stay at these extreme levels, but we're saying that they are going to be supported and stay higher for longer. But as some of the heat starts to be taken out of this, and some of those soft commodity prices start to roll down, we do see US inflation starting to come down. We know that the Fed is predicting per its dot plot to have interest rates at sort of 3.4% by the end of 22 and 3.8% by 23. Could it be less than this? Well, very possibly if, and it's quite a fine if, they manage to see, okay, we're actually breaking the economy, or inflation has come down quicker than we've expected, and therefore they are able to step back. But they are in an incredibly difficult position. It was always going to be hard to bring inflation under control with all the stimulus after COVID. Throw into that a war in Ukraine and an energy crisis. Throw into that a zero COVID policy in China. So we had another round of supply chain disruptions and what that does to durable goods inflation. And then another inflation print that's just red hot. And you can see what a very difficult position the Fed has. So in the markets at the moment, we have this push and pull between, is there a recession coming, but the Fed's trying to control inflation, and are they going to be able to finesse this all in time? What we can say is we do feel that if there is a recession, that it would be mild. Against this, and I know this is a slide we show often, earnings risks are still too high, unfortunately. They were last quarter and they continue to be. And there's no way earnings should be higher than they were during COVID. We know that the markets are effectively, the labor market is more expensive and there's been supply side disruptions. However, what is positive is so many of these valuation metrics are much cheaper than they were last quarter. So MSCI growth has come down to about 137%. The S&P 500 is off its 10-year median and is now 97, where it was 115. And the most important one is our Aussie, which is now much, much cheaper than it used to be. And we feel we will be getting support from our SA shares from China. So what we've been seeing happening in China is they've been hit by so many things in a self-inflicted recession. So they've had a zero COVID policy, they've had lockdowns, the world is demanding services and not all the factory goods that they manufacture, and they've had common prosperity, which has slashed property markets, education markets, tech markets, as they try to make the economy more affordable, as they are scared of a demographic crisis going forward. However, we must remember that China is the only place that doesn't have inflation at the moment. It's only 2.5%, and they can afford to cut interest rates. So we feel that the China stimulus could continue to support, and we should see some infrastructure underpin as a result. So last, well, how have we positioned our funds for this? We have bought a bit more ABSA because it was cheaper, and we've increased our net effective exposure, our net equity exposure, to 64%. We've switched some SASLs into the offshore oil companies because they're more attractively priced. And as you know, we've increased our foreign JSE through our NASPAS. So to conclude and leave some time for questions, recession risks are rising, but you have to watch data points very carefully. The markets are more attractive than they used to be. China has tilted pro-growth, which is positive for SA, which is very cheap. Most of our shares on a 9 PE and a 6% dividend yield, but we expect volatility to remain high and the market to be obsessed with the data points. Okay, I think I've left some time for questions.
Nicole, thank you so much for that. We do actually have some time for questions. questions. And I'll just like to start with the question on the iShares China Index. So the fund recently added this position, which is one of the biggest positions of in the fund. Was this because of China's policies turning pro-growth, as you mentioned in your presentation, or is there a more complex dynamic to it?
Dilly, you're correct. I mean, China is a classic situation of a bad position or a bad crisis getting slightly better. And so we bought into iShares to take advantage of that. And also because we expect some stimulus to come on the infrastructure side. The Chinese consumer is so shell-shocked after more than 70 days of being locked up that we don't think monetary stimulus alone is going to be enough to get that economy back to growth. And we do think they're going to have some stimulus coming through. But we don't think it's going to be a bazooka, as we said, but we think there is room, as per the slide, for further stimulus to come and support our commodities.
Thanks for that, Nicole. So the next question is, it's a question and a comment. The fund has a lower cash component, both local and offshore, from the previous quarter. This is it's a wonderful example of how agile and nimble Truffle is in allocating cash, and we really applaud you on that. So the question then is was this cash used in the international stocks, or where else did you use the cash?
It's a good question. We've used it in both. Remember that we think our SA market is very cheap on sort of 6% dividend yield. So we bought some more ABSA, and also we used the money to buy the NASPAS before the announcement of that share buyback. And then we've also bought a bit more offshore equity in terms of switching some of our Sassels into BP and Shell, which are better positioned because they don't have the chemical side to the business. They're pure oil plays, whereas Sasol has 50% of its business in chemicals, which is far more economically sensitive. And then we also let our hedges on our domestic side expire, but we've kept them on our foreign because we're still worried about some earnings downgrades to come.
Nicole, it's so wonderful seeing the different personalities at Truffle. It was amazing having you today. So thank you so much and have a good day.
Thank you so much, everyone. You too. Cheers, cheers.